just joining us, there was a major sell-off on Wall Street. The Dow dropping nearly 7%. And when you're up in the high 20s, that can be a big number, almost 1,900 points. It's worst day since March 16th. Today's big slide, the first real test for a flood of new investors who've recently piled into the market, into some, I guess, questionable, speculative names at least. Let's get to Leslie Picker with more. Hi, Leslie.
Hey, Joe, that's right. Welcome to the stock market. Lots of increased interest from retail investors who've been partially responsible for some of those wild swings in bankrupt or near bankrupt companies over the last week that we've seen. And it's left the so-called smart money kind of dumbfounded. The laws of finance say that equity holders rarely recover money in bankruptcy because bondholders, in order of seniority, get paid out first. So when shares of companies in Chapter 11 proceedings like Hertz and Whiting Petroleum began soaring over the last week, it kind of defied all logic. And that was at the expense of some sophisticated hedge funds that were on the other side of that trade. The hedge fund strategy is called capital structure arbitrage, colloquially in the industry, cap structure arb. Oftentimes, when it comes to a distressed company, this involves shorting the equity while going long the bonds to capture mispricings up and down the capital structure. But over the last week, when day traders started bidding up shares of bankrupt companies, it actually caused a short squeeze, sending those stocks even higher as hedge funds were forced to cover. So when you look at the number of shares shorted in names like Hertz, JCPenney, and Whiting Petroleum, those are way down over the last month. That's according to data by S3 Partners. Joe.
All right, Leslie, thank you. Karen, what's your take on this? This isn't the first time in somewhat speculative times that you see stocks like this behave in ways that may not make a lot of sense when it's all said and done.
Yeah, it makes no sense. And I mean, if you look at the bonds, as Leslie pointed out, you look at the capital structure, the bonds are trading in the 30s, the high 30s for some of the mid-level bonds. So the equity, it's ridiculous. This is, I think it's worse than the internet bubble in that I think the internet bubble, you could buy the story of a dream, I guess. Here, it seemed to me so much of the volume has no idea how bankruptcy works and is sort of just choosing to ignore it, hoping that, the greater fool is out there. So I wouldn't touch any of this stuff.
All right, thanks. Let's talk more about the day trading boom and one stock newbie investors have been betting on is Carnival Cruise Lines. It's one of the most actively traded stocks on the Robinhood app, and it fell 15% today. So if you're in this name and you're wondering how to get out, you are in luck. It's time for Trade School. Classes in session. Steve Grasso, take it away.
So usually when you trade a stock like this, Joe, you get it if you're lucky enough to pick it at the bottom. So it came in today, but it's up over 200% off the low. You're lucky enough to buy it off that low. You have to have an idea where the resistance is. So that resistance could be a moving average. It could be a bounce level. It could be a fib retracement. For me, I look at the fibs. So when you look at a resistance level, look at where it starts to roll over. And on a chart, you see where it hits that wall. Almost down to the dime when you look at your fib bounce levels or your fib retracements. At that point, as a trader, you need to sell either all of it, some of it, a partial. My rule of thumb is sell 25%. This way, if it trades back down and then trades right back up through resistance, it's going to pop through that resistance and you still have upside potential. If it does not return, you look between that level of resistance and a momentum indicator. I use the 20-day moving average. It's referred to as the momentum indicator. You divide up in segments of 25% from that initial resistance down to the momentum indicator. Every time it breaks down in equal parts, 4 parts, you sell another 25%. Once you get down to that momentum indicator, which is the 20-day moving average, which it was basically not even there yet today, you should be out of the stock if it breaks that level. You should only be holding 25% of the position. If you have that position left, and it bounces like these technicals and these volatile markets do, you still have some upside potential in the name. If it breaks through, you're only left holding the bag on 25% of the position. That's the way to be disciplined. That's the way to trade these highly volatile names in a retail market.
Makes sense. Thank you, Steve. Makes sense to me anyway. Guy, I have to ask you for your take on Steve's strategy and whether you'd ever wear that sweater.
First, a couple things. I can't see a sweater because I'm speaking into a blank screen. Number one, and the only two things you have to do in life are pay taxes and die. So you don't have to come to me. You're choosing to, which is fine. I hear what Steve's saying, and what Steve would also add is all this has to be in place before you do anything. So you have to have a plan before you even enter into these trades. For example, I mean, if you were lucky enough to buy CCL at $10, look, it went to $20 in a heartbeat. You sell half your position, you're in the rest of it for free. So you have to be thinking that way. You have to if you fail to plan, as Warren Buffett says, you plan to fail. So this thing should be on autopilot once you buy it. And I think to a certain extent, that's what Steve was so craftily alluding to.
What about the whole idea of, I mean, I guess you can't fault people for taking a flyer. It doesn't really sound like a way to build wealth over time, right, Steve? Or anybody comment on that? These names?
Well, here's the problem, Joe. When you're looking at these names, a profit is a profit is a profit. So when you're talking about building wealth, when you're investing and you're looking for daily increments or hourly increments, if you can clip 10% in these markets, which we see this on a daily basis, stocks are moving 5 and 10% swings. They are building real wealth. They're not investing, they're trading, and that's the huge difference.
Right.